Today we're here with Daniel Sleep, CPA and certified tax strategist. So tell me about a client who thought that they were doing everything right, but it turns out they weren't.
Yeah, typically our clients feel a mixture, right? They hope they're doing everything right, but they also have a gut feeling that maybe they're missing out on something.
Mm.
Recently, we had a client, a solopreneur, Steve, who his main client that he had was like, you know what, Steve, instead of paying you as a contractor, we will give you a W-2 and give you a 401k matching and any additional money that exceeds that W-2 will pay your LLC. And so he came to me with this like, hey, this is what they're going to do. We immediately said, okay, is there wiggle room here? Because that actually isn't the best deal for you.
Mm.
And the reason why, is because as a W-2 employee, the tax code isn't written for the benefit of a W-2 employee as much as a business owner. The reason why is because, the tax code is structured to benefit those that are taking the risk, which are the business owners.
Hmm.
So I told him instead, we should have it to where everything's paid to your LLC. And, he came back to us and said, well, what about the employer match? They're going to be able to match the 401k. And we showed him like, okay, let's say that's a few $1,000s. Well, if you're your own employer, you can match up to 25% of your compensation. So you do the math. If he pays himself 100 grand, he can match himself $25,000
Oh, wow.
just on the employer side, and that's a tax deduction. So it opened his eyes. It's like, oh, that makes sense. So we were able to prevent him from doing something that would have not just benefited him for that year, but long term.
Hmm.
So luckily, his client was like, yeah, that's actually easier on us. So they structured it that way, and we saved him $72,000 on his tax bill that year.
Wow, that's awesome. So what happened after you implemented that strategy with him?
Well, I mean, we were able to show, okay, if we implement these strategies, which were one, we created his S-Corp, we did a reasonable compensation W-2 income on his LLC, and then we did a 401k, and then we did a defined benefit pension plan. So some of that is a little hard because you have to work with a specialist, and if, we do a lot of hand holding. So, but we got it all implemented. And what was fun is I went over his tax return and I kind of joked with him a little bit. So I actually showed him the tax return if he had not done those strategies, and he ended up owing about $38,000 in taxes. And he was perplexed. He's like, "Wait, I thought I was getting a refund." And I joked with him. I said, "Oh yeah, that's what your return would have been had you not worked with us."
Nice.
And so we showed him, the real return, which was $32,000 refund on his federal, I think 3,000 on his state. And he was humored, but he was like, "I'm going to get you back." But yeah, that can be the benefit of doing proactive tax planning is, you plan these strategies, they have to fit his situation or her
Hmm.
situation. And once they do, it's authentic to the client. So they're really excited about it.
Hmm.
And then, when you're seeing the return, there's no surprises. And you're able to either expect a refund or significantly reduce bill. And it doesn't put a damper on, the things you want to accomplish that year.
Yeah. All right. So if someone's watching this and wondering, am I set up the right way? What should they do next?
Typically what we do with any person that wants to work with us is we do a tax savings analysis. So it's, an upfront fee where we set them up in the portal, they upload tax returns. If they have QuickBooks or financials that they can share with us, we'd like to see those too, because your bookkeeping streamlines into your tax return. And we want to be able to see, okay, how are those books? Because your tax planning really hinders on the accuracy of your bookkeeping. So that's the other thing. And then we'll have a kickoff call to go over our findings, see like what is the potential for tax savings. We usually paint a broad brush over someone's situation and say, okay, well, there's obvious strategies they're not utilizing. We kind of rate that on a conservative amount so that we're not over promising and we're giving them a realistic expectation. And then from there, they decide, yes, this sounds great. Let's proceed on and actually do tax planning. And we apply that upfront to their tax planning proposal.
Very nice. Just to end today, what's one small but powerful step that the viewer can take this week to get more clarity on their situation?
I think it all starts with your accounting and your bookkeeping. If you don't have, QuickBooks, Zero, or some kind of software, and you're making over 250,000 revenue, you're going to put yourself in a really hard situation because you have to have a balance sheet, you have to have your accounts reconciled, and it's really going to hinder you from moving on to the next level. So that would be the first thing is like, do you have really good books? Because if you do, it's really easy to project out taxes and calculate the savings from specific strategies we could implement.
Awesome. Thank you, Daniel.
Thank you.